Welcome to the Nova Wealth Show. I am your host, Amy Novakovich.
And I'm Jim Novakovich. We're a husband and wife team and co-founders of Nova Wealth Management.
We also teach you how to build wealth, advise you how to keep it, and how not to get taken advantage of. So let's get started. Hi everyone, welcome to the Nova Wealth Show. Thank you for joining me, just me today, Amy Novakovich, no Jim. So we're going to cover some major ground today without him. So thank you for joining. Follow me on Twitter at Novakovich Amy, or you can follow Nova at Nova Wealth Management, MGMT. Check us out on Facebook, like our Facebook page. We post daily fun tips, fun facts on Facebook, so subscribe to those, and we send out a weekly commentary that you can subscribe to too as well. So one of probably the biggest complaints that I get is, you tell me all this great stuff, like you tell me how to get out of debt, you tell me that I need to save for retirement, you tell me that I need to save for college and all the different ways, but nobody ever explains where to put my money first or how much to put in what. And it's so confusing to know, where do I put my money once I finally do get out of debt, or once I finally do save, or how much do I need in savings before I move on to investments? All these questions come up all the time, so I'm going to put it together in one show for you. We're going to talk about where do you put your money and how much, and how does that affect you financially if you put too much in one spot or if you don't put enough. So we did a show about how to get out of debt. And I would say, even before you work on getting out of debt, you have to start with savings. Because think about this. I have a little board here today. Okay. So think about this. So even if you get down, and we really don't say you need to get completely out of debt, but let's just say you get it under control, and you get out of debt and you're at zero, and that's great. But you spent, let's abbreviate savings. But you spent so much money every month trying to get out of debt that you have zero savings. Well, we all know life happens. That car rammed into me, or that rock hit my windshield, or that ER visit, or that ambulance visit is a $500 deductible. Stuff comes up. So you have to have savings. Otherwise, if you have zero savings, where do you get the money if you have something that comes up? So you would, of course, have to go back into debt. So, okay, all of a sudden now I have a medical bill. All right, so now I'm working on paying down that medical bill. Every month I'm paying a little bit to pay down that medical bill. I still have no savings. I get back down to zero debt, and what happens? Something. The washer breaks, and now I have a $1,000 washer and dryer that I have to replace. So I go back into debt. So you get in this cycle of being reactive. You're reacting to things instead of being proactive. So the number one thing you have to do first is save. You have to get 6 to 12 months of your monthly expenses in savings. And I say 6 to 12 months, I'm going to erase this. 6 to 12 months depending on your age. So the older you are, the closer you are to retirement, the less that you need monthly in expenses, because chances are, I hope so, after watching our shows, hopefully you'll get organized, but towards retirement, you should have more funds in investments and in retirement funds, and your expenses theoretically should go down, especially once you get on Medicare. So the first thing you need to do is save. So let's actually put that back up here. First thing is save. And how much? You need 6 to 12 months of living expenses, we'll call them, in your savings. I hope you can read my writing. 6 to 12 months of living expenses in your savings, so that for a rainy day, emergencies, unexpected things come up. Now, your savings is not for vacation. Your savings is not for things that you are planning. Those are called goals. That's different, and we'll get to that. But the first thing you do is save. So again, where do I put my money? The first thing you do is save, because that way you're proactive and you have things for emergencies, and you don't have to go into debt, or you don't have to pull from your vacation fund. That's the first thing you do is save. All right. After saving, Once you get a savings built up, I want you to calculate what we call your discretionary income. And if you don't know how to calculate that, go back to the show where we talked about how to get out of debt. You actually have your, and I'll just do it real quick, I guess, your fixed expenses, your variable expenses. Then you have the amount that goes towards savings. So you have leftover, essentially, your discretionary income is how much you have to spend in a month. Not food, that's an essential. Okay, not food, not gas, that's essentials. You need that to live. I'm talking about spending, like how much money you have to just go out and shop for a day if you wanted to, which we all do. So your discretionary income. Once you get that number and you have a savings account, your discretionary income can now be used to start saving for your goal. So if you have a vacation fund, if you have, I'm trying to think, down payment on a home is a huge one. Can't believe I almost forgot that. See, this is why I need Jim here sometimes too, to think of things. So down payment on a home. If you have a gift that you're saving for, maybe an engagement ring, something like that. Whatever the goal is, start saving for that, but only do a little amount. So let's say your discretionary income, and I would say 10%. Let's say your discretionary income on a monthly basis is $500. I would take $50 a month, or 10% of the $500, and put that towards your goal into a separate account. I would not commingle this with your regular emergency savings fund. Savings and emergency fund, I would call it one and the same. So how much that you actually put away into your goal is obviously predetermined. So maybe you need $5,000 for that vacation. I don't know, whatever the number is. So you start saving $50 a month, or 10% of your discretionary income. Now, at the same time, so this is something that you're not focusing 100% on the goal. You're at the same time getting your debt in order. And again, we talked about debt. We talked about in a previous show how to get out of debt, and we gave specific examples on how to get out of debt. So at the same time, you will be getting your goals saved for, and you will be getting your debt paid down and under control. I say under control because a mortgage is not bad debt. Unless your interest rate is like astronomical. A mortgage is not bad debt. As of right now anyway, this is in 2018, for this year, your mortgage interest is tax deductible, but your mortgage rates are pretty low for the most part, and you can carry out the payment for up to 30 years. So, and it's for your home, it's for an asset. So it's not bad debt. So the other one is student loans. Student loans is not terrible debt because if you get into financial trouble, you can defer them. You can make them last over many, many years, and they are very low, and the interest rate is pretty favorable as well. So I wouldn't consider that bad debt. I talk about debt like your credit cards. Credit card debt, medical bill debt, your unsecured loans, your debt, your car loans, even though for a depreciating asset. So all that is debt that you want to try to work on to get paid down. Then I'm going to be doing a series, and I'll probably do it with Jim. But I'm going to be doing a series of what to do if you're 30 years out from retirement, 20 years out from retirement, 15, 10, 5, and 2 years out from retirement, let's say. But for right now, let's just assume you haven't started saving for retirement yet. So let's recap. So we've got, first of all, what do I do with my money? I save first in an emergency fund. I save 6 to 12 months of my living expenses. So let me explain that real quick. If your living expenses on a monthly basis, your expenses that you need to live, okay, are $2,000 a month. Yes, I want you to have about 12 grand, or 6 months, 6 times 2 is 12. 12 grand in a savings in an emergency fund, okay? So the first thing you do is save. The second thing you do is goals. If you can't tell, I'm a little stuffy. Goals and debt. Goals and debt. So this is 1. This is 2. Goals and your debt. That's what we just talked about, okay? So you start saving for your goals at the same time that you're getting your debt in order. That's the second step. Now you can go on to making your financial well-being for later in life, okay? So you're going to save for your kids' college if you have children. Not everybody has children, but you're going to save for your kids' college in this next section. So you're starting to save for later. We're just going to call this later. So this includes college. This includes retirement. And all that good stuff for later in life. Okay? So, once you get your goals and your debt in order, now you can take your discretionary income and start every month automatically putting away money, again, like it's a bill. You know, automatically deduct $100 a month, have the bank take $100 a month and put it in a retirement account for you. Whatever it is, whatever the number is, $500, $1,000 a month, whatever you can do. And you save for college. So college, there's calculators online. Maybe I'll post it, I'll tweet it, that you can estimate how much for college. There's so many different college programs, and actually we did a Facebook Live. We do a live every week on Facebook, a Finance Friday, where you can ask live questions. And I did one on all the options on how to save for college. So we can do, we're not going to go into it right now for the sake of this show. We're going to actually just say you're going to take all of your discretionary income and just try to take half of it. Half. I know that's a big number, but if you have $500 a month of discretionary income, again, discretionary income is the money that you can spend every month. Take half and put that away for either retirement or college, whichever comes first. Obviously, your kid's college is going to come first. So if you save for college first, maybe for 10 years, and then once you've got some money built up at college, then you can start focusing in your retirement. So take half of your discretionary income and start saving for retirement. Now, what do I mean by saving for retirement? Because there's retirement accounts, but then there's also just regular investment accounts. When I say retirement account, I just mean like IRA, 401k, and things that are for retirement specifically. Why? Because they're taxed differently. And we don't need to get into all the different types, but IRAs, there's several choices of IRAs too, and we have multiple videos on that too. But IRAs are advantageous in taxes, whether either now, you either get a tax deduction now, or it comes out tax-free later, depending on which type of IRA you choose. So you definitely want to maximize your IRAs, and you definitely, if your company has a match in the 401k, ask. If you don't know the answer to this, ask. It is insane. There's nothing else in this world that can get you 100% appreciation instantly. So if you contribute a certain percentage of your salary and they match that percentage, usually it's like 3%, 4% of your salary, that's free money. They literally give you money in your 401k for you. It's yours immediately, usually, depending on the 401k, but most commonly, it's yours immediately. So just imagine this, all right? So every paycheck, let's say you're putting away $200 into your 401k, every paycheck you would see $200 come in from your company. Free money, instantly. Your $200 just made you $200 instantly. There is nothing else on this earth that can do that for you. So I highly suggest saving for retirement, that last bucket we just talked about. Focus on your 401k first if you have an employer match. If you don't, do your IRAs because they're tax advantageous for you. All right, so let's recap real quick. I'm going to wrap it up. Where do I put my money? There's so many things to do. There's so many things to think about. Where the heck do I put my money? The first one is you save, because I do not want you reacting constantly whenever anything comes up in your life, because stuff will come up. So we know that's going to happen. So just save for it. You're going to have 6 to 12 months of your living expenses on hand. Six months is actually probably good. You know what? I'm going to take this away. 12 months is quite a bit. Let's say 6 months. All right? I like that. 6 months of your living expenses on hand. Now this is, again, when I say living expenses, it's the expenses, what you need to survive. So not your credit card bill, not what you spend every month. What do you need to live? So your mortgage payment, your car payment, your insurance, your food, your gas. That's your living expense in a month. 6 months in savings. So that way, anytime anything comes up, you don't have to stress. You've got the money for it. The next thing is you save for your goals and you get out of debt. You get your debt organized with the exception of your mortgage and your student loans. You get your credit cards paid down. You get your your medical bills paid down, and you get your monthly payments caught up if you're behind on your car loans. You don't have to get your cars paid off. It helps because a lot of things can go wrong if you're not properly insured, or if you want to get a new car and you're underwater. So you want to try to pay the car down, but I really am just more focused on you getting caught up rather than just paying off the car. Okay, and then you save for later, and you do whatever comes first. So if you have your kids, then they're 10 years old and they're going to college in 8 years, you have to focus on saving for their college first over your retirement. I'm sorry, but your retirement is like 30 years out versus 8 years out in college. And if you don't save for their college, guess what? It's going to affect your retirement, unless you make the kids pay for it, I suppose. And you can do that. I probably will do that, actually. But if you make the kids pay for it, just know that they may not finish. That's just the fact. I paid for my own college. I know Jim paid for his own college, but it's definitely harder to have to pay for your own college. So that's just an idea. If you're trying to save for your children's college, let's say that. If you want to save for your kids' college, then you're going to want to do that first over your retirement. Okay? So, if you have more specific questions, or if you have a specific situation that's completely different outside of this general talk, because this is just general information, go ahead and go to our website and hit the contact us button, and it'll reach out to me directly, and I'll answer your questions individually. I have no problem doing that because I know this gets overwhelming, and sometimes it's even confusing. As basic as we're breaking it down, sometimes it's still confusing because your situation might be a little bit different. So, thank you for joining me. If you have specific questions, reach out. Go to our website, novawealthmanagement.com, and we'll see you next week.